Hello guys, welcome back to my YouTube channel Yuti Sankhe's MBA journey. My name is Yuti Deepak Sankhe. My roll number is MB20003 and today's subject is our financial management. In that we will see one topic, that is top down and bottom up approach. So let's further, we will start with the meaning of top down and bottom up approach. First thing is top down and bottom up approach. What is the meaning of that? Firstly, we will see the top down design model. In that, it is a top down processing which focuses on a background knowledge a reader used to compress a written text. Then second thing is, it is an approach to a problem that beings at highest conceptual level and work down to the details. Then third thing is, in the top down model, an overview of the system is formulated without going into details for any part of it. Then each part of the system is then reunified in more details, and each new part may then be reunited again, defining in it more details until the remembering specification is detailed enough to validate the model. That is all the related thing about the top down model. Then next we will see bottom up design. In the bottom up design, the bottom up approach is the opposite of a top down approach. We already saw the top down approach. Then instead of taking a material away to make a structure, the bottom up approach selectively adds atoms to create structure. Then another thing is, in bottom up design, individual part of the system are specified in details. Then the parts are then linked together to form a larger components which are in tune linked until a complete system is formed in a bottom up design. Then another thing is, object oriented language such as C++ or a Java use bottom up approach where each object is identified first. Then next we will see top down concept in a problem solving. If we look at a problem as a whole, it may be seen possible to solve because it is too complex. Example is writing a university system program or writing a word processor. Complex problem that can be solved using top down design, as also known as stepwise refinement, where we break the problem into parts, then break the parts into two parts. Soon each the parts will be easy to do for us. Then next we will see one diagram on the slide, that is about bottom up approach and top down approach, how the flow is going. For the bottom up approach, first thing is addressability, fundamental understanding or market, and company specification and known market specifies, that are categorized in three parts. Last one is company specification, fundamental understanding, and then addressability for the bottom up approach. And next one is a top down approach. For that, addressing is the last, then competitive and penetration, and then the understanding of a macroeconomy. They both are the opposite in natures, where top down approach goes like this and bottom up approach goes like down. Combining both top down and bottom up research, what will happen? We will see top down begins with a high level and bottom up begins with a specific on move toward. As a greater rule, the top down approach begins with the highest level toward the globe economy, and from the move toward a more narrow view of a specific asset class and a global industry, where the bottom up approach meanwhile start with the specified and move toward a more general view of the economy. Most portfolio manager find it best to employ both approaches when developing their economy forecast, because both are the helpful in a nature. So that's why combining it is helpful for the organization. Then by doing this analysis, we would also help their wealth manager client to avoid outsized loss that led from the eventual collapse. For example, there have been a criticism that the bottom-up investment philosophy has at time been overly optimistic at a market peaks, where also being overly pessimistic at a market through or a bottoms. While the criticism that has also leveled up for the bottom-up analysis is that it tends to be centered around of something recent history to attempt to predict the future, and that carries the risk of a something leverage investor unprepared for unexpected increases shocks to the economy. So by doing this analysis would have also helped the wealth manager to avoid the things. All the things happen with the combining top down and bottom up research. Then advantage of top-down design, that first advantage is breaking the problem into parts, help us to clarify what need to be done firstly, then lastly, and we can decide the order by helping the breaking the problem into parts. Then second thing is at each step of refinement, the new parts become less complicated and therefore easier to figure out. With the help of breaking, we will find the easier one and we will find the difficult one. Then part of the solution may turn out to be reusable. Then breaking the problem into parts allow more person to work on the solution. It is the most helpful advantages for the top down design model. Then next one is investing in top down and bottom up approach. For firstly we will see top down model. Using this model approach, start their analysis by looking at a microeconomics factor before working their way down to individual stocks. For example, a top-down investor might start their analysis by looking at what a country have faster growth economy. Then they might looking at individual sector with this economics to the find the opportunity. Then finally they will look at an individual company with their specific sector before actually making an investment decision. The investor might also look at the other macroeconomics factor, that is always as well as economics or a business cycle. Then top down investor benefit from access to a diversified portfolio of a asset with a given country's region or a sector, since they use funds or exposure. Then another thing is the primarily drawback is that they have relatively little control over the ultimate makeup of the portfolio unless they invest in individual equities or bonds. Their portfolio may also have concentration risk. They focus on specific country or sector rather than the diversified. Then investing in bottom up approach. Investor using bottom up approach start their analysis by looking at the individual company and then building a portfolio based on the specific attributes. For example, a bottom up investor might screen for stocks trading with a low price or a low PE ratio, and then review company that meet that specific criteria. Then they will take a deeper look at an individual company that comes to the secret and evaluate them based on their fundamental criteria. Most bottom-up investors are microeconomics investors that focus on specific attributes of a company when building their portfolio. They tend to be a buy and hold investor since they invest a lot of time researching individual stocks rather than the environmental surrounding these stocks. Then third thing is the bottom-up investor benefit from a portfolio than often well diversified in terms of industry and geographical, and they know that every component of their portfolio meets their investment goals. From bottom up and both of this approach we will get best approach in this. Firstly we will know that there is no single approach that right for all investor, because both the approach have their own features. So decision between top down and bottom up investing largely matters of a personal preferences. First thing, then it's worth nothing that these two investment style and not mutually exclusive. Then the key successful using these techniques is identifying the correct criteria and analyzing them in a wider context. Many investors combine top-down and bottom-up investing when building a diversified portfolio. For example, an investor might start with a top-down approach and look for a country that's likely to see rapid growth over the incoming years or two. They might then take up a bottom-up approach within the country by looking for a specific investment such as companies with a low price earning ratio or high yields. Then conclusion, the more complete an understanding that an investor will get from this about his or her wealth manages investment philosophy, the more productive and enjoyable that relationship stand to be. Investor and their advisor should do their best to work together to foster an environment of a transparent and open communication about the philosophy and thought process that goes into the investment management framework. As a result, investor will be better position to know what question they should be asking by the wealth manager, as well as how to respond to their advisor explanation of the activity taking place where the investment accounting. Thank you. I hope you like the video and you understand top down and bottom up approach in my words. Thank you so much.